Welcome to the Rick Helps Real Estate Show. Trying to make sense of this crazy Arizona market. Even though I'm still not in Arizona, I'm keeping you up to date, broadcasting to you today from the palatial estates of my brother's house. So, in fact, that's my dad's old fishing pole behind me. I don't know how he ever caught anything with that thing. His old fishing pole, his bag. You can see the bait bag back there. So, it's kind of a little nostalgia down here. He was a barber, so there's a barber pole hanging over there, his straight razor. So, always fun to be home. So, looking at the real estate market, it's not easy right now. You look at certain things and you go, well, when we see this, then this will happen. We're in such uncharted territory that it's even impossible to guess and predict. For example, I thought as inventory was getting tighter that we would see fewer seller contributions helping out buyers, but that's not the case. I'm going to share some of those numbers with you. And then the other interesting thing is since FHA has made some changes, they the new FHA loan limit is $530,000. The number of loans going FHA versus last year was 9%, and today it's 22%. So they also lowered their private mortgage insurance by hundreds of dollars per month. Good morning, Danila. So that's making more people not only use FHA loans, but sellers willing to contribute to help buy down the mortgage rates. And how much are they willing to contribute? So I thought that when we saw a peak here at 51%, that as rates started to come down, that this would decline. That part was true, but they haven't gone down much. We're sitting here at 42% seller pay concessions with a median concession of $8,000. So that's probably helping you buy down your rate, like with a 2-year buy down. So they're doing it. And then also, check with your lender if you're a first-time home buyer, because they're starting to introduce more and more FHA first-time home buyer loans. Now, the dirty little secret is first-time home buyer doesn't mean that you've never owned a home before. It just means you haven't owned a home in the last 3 years. Now, if you've owned a home and your spouse has not owned a home in the last 3 years, let's say you just got married and your spouse hasn't owned a home the past 3 years, both of you qualify for some of these low down payment first time home buyer loans. So something to inquire about your lender too. Trending topics here says this morning, Open Door has basically sold off their entire Phoenix inventory. So much for crashing the market. Absolutely. They didn't, while we saw some incredible discounts on their houses, they were discounts from their inflated asking price. They were not at market price. So in other words, a house that was worth $500,000, they were still asking $575,000. So even though you saw a $75,000 reduction in their price, they still didn't blow out below the market price. They did in a couple, but they didn't flood the market and ruin the market. They certainly got aggressive for a while there. They were up to almost 10% of our sales, but once again, it's a non-event. I remember in 2012 we were supposed to have this shadow inventory, and it was all these homes were going to show up in droves, and everything was going to be awful, and it wasn't. So we guess, we think, we pontificate, and then we wait. Running it out to you. Do you have any links for first-time homebuyer program assistance? I'll get some stuff out to you. Shoot me an email at rick@rickhelps.com. Let me see what I can do for you. Here's my little handy dandy 7-day moving average that I do. And this has a little downturn here for listings under contract, the red line. The blue line is new listings over the past 7 days. So they ticked up a little bit, barely. And new contracts went down a little bit, probably because of Father's Day. Although I got to admit, none of my boys bought me a house this weekend. So I don't know how much of that was going on. So there was, little tepid activity over the weekend. Nothing major. Our active listings are still kind of flattening out a little bit. They were trending down here, and it looked like we were going to continue to slide, and now they've kind of flattened down. So, and that's because of our lower amount of listings going under contract in the chart I just showed you. And here's kind of put it in a historical perspective, although, history doesn't mean anything now. But if you look at pending listings right here, and we look at today, 5,517. Well, let me get my handy dandy magnifying glass back again. So pending listings, 5,517. That's down from last month where we had 6,377, and last year 5,809. So we are down versus last month. We're slightly down versus last year by about 300 homes, but that gives you kind of a snapshot of the market. Active listings right now, as of today, they're saying we have 14,976. That was of the 18th. We really don't have that many. We're down to about 11,800. And compared to last year, we had 17,000. So 17,000 seemed to be the point where you go, well, if I'm on a list, I better do it now before it gets up to 20,000. That's what a lot of people experienced. They thought they could get out from underneath their homes and grab what equity they had as soon as rates popped up. Rates popped up. People listed their house. Oop, that didn't work. And just like a turtle, they just kind of retreated. And now everybody's sitting back and waiting. This market can best be described by a whole bunch of people on both sides simply waiting. Waiting for what? One side's waiting for price reductions. The other side's waiting for rate reductions. Who's going to win? Who knows? And if you do see a big reduction in rates, which I think are highly unlikely, then you would have everybody just coming out in droves to purchase a home. And we can say that with confidence because we're seeing that in the new builds. New builds are doing quite well. In fact, Jackie ran some numbers for me over the weekend, and she was pointing out that 25% of the homes that are pending in the multiple listing service are homes built after 2022. In other words, new construction. And not all homes that are under contract show up in the MLS. So the amount of new builds versus resales is staggering. And then she further went down and said, okay, well, how many homes that weren't built in 2022 that are below 600,000? Is it 600,000 or did she say 400,000? Anyway, the number was staggeringly low. So that's what's going on with the inventory out there. You might want something between 400 and 600,000. You're out there looking, it's just not there, but it is in the new build community. So off you go. You get a lower rate, you get a brand new home, but unfortunately, some of it is far, far away. And David, thanks. Great to have you on the show this morning. So it's an interesting market. We are airing the interview with Barry Habib Wednesday night. You'll get notice that it's premiere. So if you haven't subscribed, please subscribe so you can get an alert. Click that little bell icon to let you know when that's going to post. It's going to be about 6 or 7 o'clock on Wednesday night. Did I say Thursday? I got wait here. I got to go up and get another cup of coffee. So speaking of new construction, there was an article out here by Market Watch that said, for the first time in nearly a year, home builders are upbeat about the housing market outlook. So they're pretty pumped about what's looking ahead. The shortage of previously owned sales is helping to buoy builders' confidence. With mortgage rates above 6%, many homeowners find little incentive to sell. Nearly 92% have an outstanding mortgage with a rate below 6%, according to a recent survey by our friends at Redfin. And it said 23.5% of homeowners have a mortgage rate less than 3%. That number jumps up to 49%, less than 4%. A lot of numbers out there. Consequently, the number of new home listings has dropped by 22% as compared to the same period a year ago nationally. So in turn, home builders are feeling good about their business. Their monthly confidence rose 5 points to 55 in June. So that's pretty significant. The builders are out there saying, yeah, it's looking pretty good. Everybody's gravitating towards us. Let's build some homes. Now they're starting to build more first time home buyer homes in the 300s. Unfortunately, they're not very close to town. They're out in Buckeye. Lennar just announced a bunch of them in Florence that are going to be in the 300,000 range with rate buy down. So the homes are out there, but you got to drive. What do we call that? Drive till you qualify. So the inventory shortage is persistent. And it just looks like, barring any economic shocks to the system, such as a sudden credit market freeze and the like, that this is where we're going to be the rest of the summer. We're just, as Pat likes to say, we're just going to muddle along. And it's pretty clear to see why. There's not a whole lot of activity going on out there. In fact, the number of sales that we have on a weekly basis, like I showed you on pending listings, is down about as low as we've ever got. And the number of homes available is also low, but that's when I measure the gap. So the gap is the number of new listings that come on and the number of listings that have gone under contract. And today we're at 84% new listings to new listings under contract. When that gets down below 70, then there's pricing pressure on the downside. That's a real true indicator that we can watch, that's kind of immediate. So we can take a good look at that in our market on a 7-day moving average. You go, oh, there's a canary in the coal mine. Let's take a look at this. Way before that shows up in studies like Case Shiller, those guys run about 2 to 3 months behind as they compile all this data, national and regional. But for us, if we just watch that number and the gap between the two, that's your indicator of where the market's going. Now, new listings are not going up, so there has to be a catalyst for that to happen. Is it job losses? Could be, if we start seeing more job losses. In other words, that electric car maker down in Coolidge just announced they're laying off 300 people. So, if there's people that went down there and bought a home, then they may be forced to sell their homes. If that expands in the rest of the market, you may see some of that, maybe more of it. But it's not going to give us a huge spike in inventory. It may just dribble a little bit and they may just get gobbled up. Berto, morning from Norway. Wow, I'll be back in Arizona. Still love the info. Have fun in Norway. That sounds fun. Running at Altitude says, how are the sales prices versus list price ratios? Are homes selling at or above or below the listing price? Let me take a look at that for you here. I'll see what I can pull up. And there's a couple things that I can look at. Let me share this with you. And you know what I say when I'm doing this. I go, give me a minute, talk amongst yourself. Let's see. New listings paid. I go to it so many here. Closings over list price. Here we are. Now, remember, this is going to lag by 30 to 45 days, okay, because it takes a while. But they've gone up to 21% as of June. Those are contracts that were written in May or maybe late April. So closings under list price in December went way down, but the market there was nothing going on in November, December. So there was no overbidding. So when you look at the details here, you can see the price range where you're seeing a lot of over list price. So 300, 400,000 has got, 25%, 2 to 250, of which there's only 431 homes for the month, is at 29%. 5 to 600,000, there were 885 homes, or 19%. And then these are the amounts here: 5,000, 5,000, 7,000. So 4 to 500,000, there were 7,363 is the average that they bid over, and it went from anywhere from $1 to 72,000. So when you look at the average on those, it tells you something, but it doesn't tell you a lot, because every once in a while there's just one big dollar amount that comes in there that throws you off. And somebody paid $72,000 over list price on one of those homes. It throws the whole thing off. So you go here to the 506,000 range, and it's saying the average is 10,000, and somebody paid 65,000 over the asking price. So kind of take those numbers with a grain of salt, but you can look at the percentage and say, well, it is trending up. And again, because of the gap, we're at 84, between 80 and 90% now of new listings versus listings under contract. Unless that slides down, we're going to have some upward pricing pressure. In fact, our negative sales for the year, price appreciation for the year, is probably going to level out in the next couple of months, where year over year comparisons, we're not going to be negative anymore. We'll be flat to last year. And that's the trend that we're seeing. I think there's another one that I can look at here that also kind of shows listing success rate. And sometimes this chart gets a little dirty, and there's no denying that. Look at this. There's got to be a better one here. Let's see. Listing success rate by city, 100% in all these cities. We got Chandler at 89.7. Almost 90% of you, when you list your house, you're selling it. The lowest is getting down into Queen Valley. I don't even know where that is. Valley Farms, Paradise Valley, 65, Cave Creek, 72. So listings are still selling. When I look at the Cromford Market Index, which I really like, in the which shows supply and demand here. If I can look at that again, here we are, Cromford Market Index, supply versus demand. I like this one. It kind of looks, again, it measures the gap, right? And the gap is right here. See where you've got the red line, which is listings under contract, and then the blue line is inventory. Get the handy dandy magnifying glass out once again and see if I can show it to you. I got to move this over just a smidge. It may not do a good job of showing it to you. It doesn't. It's not cooperating. But when that gap grows, the red being above, the blue being down, even though sales are as low as they are, there's still enough of a gap to where you're going out looking at a home, and so are 5 other people, and they want it as bad as you do. Hence, you got to sweeten the pot a little bit. Not as bad as you had to right here in the silly selling season of 2021. Those waiting for a crash, you're going to have to see something like this happen. You're going to have to see listings fly up to where they were, way up here. This was 58,000 listings available, and then sales were, there just weren't any sales. So, you're waiting for that. There's, like I said earlier, everybody's waiting. Waiting for something, and so we'll see what happens. There's one thing that I looked at that was really kind of a concern to me, that now the more I dive into it, it may not be as big of a concern, and that is that the Treasury has to fill their checking account, per se, back up by the tune of about $1 trillion, because in January they couldn't borrow anymore because of the spending limits. Now the spending limits are like, oh, don't worry about it, they're gone. They're selling treasuries to the tune of 170 billion last week, and in order to attract buyers, obviously they have to offer higher yield, and the higher the yield, the higher the mortgage rates are, and it's putting a credit squeeze on the system, but not as much as we thought it would be, because tucked in the background, something that the central banks created a little while back is called the reverse repo market, where there's $2 trillion sitting in there. So if we did have some kind of liquidity issue, this 2 trillion gets shifted over to help keep banks liquid and keep credit flowing. So while the alarms are being sounded, it said, oop, they got to borrow $1 trillion. Here we go. We're going to have a credit squeeze. This looks awful. You've got that other pool of money sitting out there, which has never been there before. Like we say, what's going on right now with the economy, with the central bank, we've never seen before. So it's hard for even the professionals to say, well, here's what's going to happen. We don't know. There's just so much moving of money. And it is a very scary and complicated time in financial markets because of the amount of debt we have, 120% of GDP. So it's not sustainable. Fed chairman finally came out last week and admitted that, it's not sustainable. And they were kind of saying, well, why don't you beat up on Congress a little bit? And he's, well, it's not my job. Well, it might be. Your job is to keep the dollar stable and keep the economy humming and keep employment at a manageable level. So if our level of spending is too much, it's okay to say something. And he seems a little timid on that front. That's about as political as I will get here. The other thing that you're hearing a lot about now is commercial real estate, that there are a lot of loans that are going to be reset. There's a lot of leases that won't be renewed. That looks like it's not going to show its ugly face until 2024 and 25. So we don't see anything in commercial real estate that's going to bleed into our market this year or even early in 2024 that's going to cause a problem. But I'm going to ask Barry Habib about that when we interview him, and we show that on Wednesday night. So I have a lot of questions. We've only got 30 minutes with him. And he has wealth of knowledge. He was on last week. He was actually interviewing one of the main economists from Goldman Sachs. He was on with him for an hour. Great show, and pretty deep. So you kind of have to listen and rewind it. What did he say again? The guy from Goldman Sachs. So it was quite entertaining. And if you're into that wonky stuff, trying to understand the markets, those are interviews like that are casual are pretty good to gather as much information as you can. Well, look, everybody, I'm going to skedaddle here, and it's supposed to be a balmy 53 degrees up here next couple days. Had a fun Father's Day. Hope you fathers out there had a good one as well. And I will see you soon. Don't forget to subscribe so that you get notification of the Barry Habib interview on Wednesday night. I know you're going to like it. Thanks for watching. Take care.